Good morning, all, and welcome to this WCA webinar with WCA Associate Member Wipfli. And today we are talking about GASB 87 lease standards. As always with our webinars, we encourage you down below to enter in your questions into either the chat or the Q&A, and we'll get to them as the webinar is continuing. We're not going to wait just until the end. We welcome our speaker today, Brian Anderson, with his CPA and Senior Manager with Audit with Wipfli. Brian, thank you so much for being here today. And with that, I'm going to hand it over to you.
Yeah, thanks, Michelle. Yeah, glad to have all of you join us here. Nice to have this capability that COVID brought on to be able to do these webinars. So as Michelle said, feel free to pop in some questions as you go through. There's a lot of information in GASB 87. I do have a lot of slides here, but I definitely want to address any questions that anybody has as they go through this information, has been thinking about the standard. I guess I can start with a little bit about myself and then I can go into GASB 87. So I do have some information. Like I said, I'm Senior Manager with Wipfli. I focus 100% on governmental work in the GASB area. So that's helpful to kind of stay on top of everything here and help our clients implement the new standards. So this GASB 87, just some background, it was issued probably 3 or 4 years ago. And luckily with COVID, we got a 1.5 year reprieve as far as when this needed to be implemented. So it's supposed to be implemented now, but with the reprieve and you as a county is a year end of 12/31, you actually got 2 extra years to implement the standard. So that's nice. So that it's been out there a while, but you haven't had to do anything too much with this before. So I'm here to kind of get you ready to implement, which as I'll share later in the slide will be for your 12/31/2022 year end. So you're not in the year now, but as you get to the next January, you'll be in that year that you need to implement. So definitely the more you can do up front now to identify your leases, the better off it is in the long run to make sure you got everything addressed. So in summary, in the past, the guidance with leases is you either qualify as a capital lease, meaning you pretty much own it, and you record a balance sheet or asset on the balance sheet along with the related debt. And then also you could qualify for operating lease, meaning you only have it for a short portion of the asset's life. And with that, there's no recognition on the balance sheet and just payments are shown as operating expenses. Unfortunately, GASB found out that, I guess here's the term for the old capital lease criteria here as far as how that definitions will go. So with the new model under GASB 87, they kind of said people were unfortunately playing games with operating and capital leases and kind of making sure they write up the terms of the lease to get slightly under that 75% useful life or 90% of the value, and they're kind of playing a little bit of games. So what GASB likes to do is if they find too many people playing games, they change the rules on us and make sure that everybody's recording it consistently to know what's actually going on, the substance of the transaction instead of the operation. So with that, the concept of operating capital leases no longer exist. It's all going to be treated as a financing transaction and be classified as such. So there's a lot of definitions with that and a lot of definitions for how this goes and how it gets recorded. So basically, you're going to have a right to use asset along with a corresponding liability. Whenever you enter into an agreement that's going to last longer than 1 year, you're going to have to account for it in some way or another on the balance sheet instead of just on the income statement. And then you're going to have some additional disclosures. In the end, it's going to provide more useful information for your financial statement users. So obviously, GASB is not creating rules just to make our life more difficult. In the end, it's supposed to help the users read the financial statements. So they did define in the standard what a lease definition is. Pretty standard contract that conveys the right to control an asset for a specified period of time in exchange or exchange-like transaction. And you have to have control of that asset. It's not basically you can get use of the asset and the right to determine the use of that underlying asset. So it's not like you're just temporarily using that asset for various purpose and then you can't really do anything with it. I guess an example would be just temporarily using a vehicle for, well, I guess temporary wouldn't even qualify, but just say you're going to go off and use probably the best example would be a building, using a room in the building. So you're just using it temporarily for maybe 6 or 7 months out of the year, but you can't really change anything with that building. You have to use it as the owner tells you to use it. So that wouldn't qualify. Yeah, there's a lot of situations this to qualify for. So it's hard to come up with examples for everybody's situation, but that's kind of the underlying point of that. So maybe apply that to your specific situation, that you have to have the use of the asset and you can determine the nature of how that asset is being used. So as I said before, there's 3 types of leases with this new standard. One is that short-term lease. So if you do have a lease that's less than 12 months, including extensions, you can still apply that operating lease guidance in the past, and you don't have to worry about recording the asset and liability. So anything you can do to get that lease to be 12 months or less, obviously that's going to help with accounting. Obviously there's a lot of economic substance with this transactions, and that takes #1 priority, but anything you can do to kind of get it easier for us as accountants to account for the transactions, the better. It obviously has to transfer ownership over to the other party. Like I said, it has to be longer than 12 months. And then we also have the longer than 12 months capital lease. So they did, there's implementation guides for all of these lease standards. So one question that they did ask and address in that implementation guide was, the government enters into a lease with a 6 months non-cancel period and an option to extend for another 12 months. And government is, even though they don't plan on extending it, there is that option. So it's not a short-term lease because there is more of an option at least to get to that 18 months. So even though they don't plan on extending it more than 6 months, you still have to apply the guidance of GASB 87 as a long-term lease. But as I said before, that lease term would only be 6 months, because we're going to get into some guidance here. It's all about what you reasonably expect to do when you initially enter into the lease. So with that, it would only be 6 months. So like I said, identifying the lease term is going to be a critical part of how we're going to account for this, because you're going to be amortizing that lease payment, and then I guess it's not depreciating, but it's going to be amortizing the asset as well. So the lease term is going to be critical here. And like I said before, it's going to be what you reasonably expect to do with this lease when you enter it. So if there's an option to extend and you plan on extending that lease term, it's going to add to the life of the lease term. So say, for example, you enter into a 10-year lease with an option to extend for another 10 years. If you expect to extend that lease for the next other 10 years, then you need to consider the lease life of the asset to be 20 years. Same thing on the other side. If you have an early termination where you expect to exercise that option, you would remove that from the lease term. So that's part 1, and when you're trying to account for these. And then if obviously things change, you're doing some estimates, but what you reasonably expect. So if you extend and we didn't plan on it before, or you terminate and you didn't plan on it before, you adjust the lease term accordingly, and you do some journal entries to kind of get everything right. So there are some other definitions here. So periods where both the lessor and the lessee have the option to terminate without permission from the other party are cancelable periods and excluded from the lease term. So if you lease an asset, you have a right to cancel, or either party has a right to cancel. You can't include those terms because the other party could cancel on you. So those periods wouldn't be included in the lease term. So an example, rolling month to month or holdover lease is cancelable if both the lease and leaser have the option to terminate at any time. So you do see a lot of these lease terms where, even though you plan on doing it for 2 or 3 years, if the other party can cancel on you at any point, it's really not a lease. So I guess that's good news, and you don't have to account for that with this new standard. And GASB did address the fiscal funding or cancellation clause, because typically governments only are obligated or can obligate for 1 year, because a new board could always change things based on a fiscal funding clause. So even though you do have that ability to cancel the lease, the government's saying most times those clauses are ignored because the next board or the next government does extend the period. So that wasn't a way out of the standard, according to GASB. Another small thing with this was cancellation penalties. They're saying sometimes those cancellation penalties are so high that it does make it difficult to get out of the period. But GASB, for some reason, they said the presence of cancellation penalties does not affect the conclusion as far as what having those periods included in the lease term. Get some more technical stuff here before we can kind of get into examples. There is some arrangement not in the scope of GASB 87, and it's more because there's other standards that have addressed these, or you can continue to include the guidance that's been in place before. So short-term leases, like I said before, they're not included. Old capital leases, it's pretty much the same accounting as it was for the old capital leases. So if it was qualified as a capital lease in the past, continue to use that guidance. Intangibles is going to be addressed in another standard. Biological assets, inventory, they're saying that's more a temporary right to use those assets, so that's not in the scope. Assets financing outstanding conduit debt and supply contracts. Another question that they asked here was government obtains the right to use land which has a market rent of 100,000 a year for $1 per year. You kind of do see this a lot at the counties where it's not really an exchange transaction. So with that, it's not going to be under the guidance of GASB 87 because it's not an exchange transaction. So continue to pretty much account for that as you have in the past, which is pretty much nothing. So with this here, I've got a nice little chart to kind of show the accounting for all of these transactions on the balance sheet as well as the income statement. And I know probably the difficulty with the standard will be the government-wide statements, which I know some of the larger counties, I'm sure, write their own statements, so they definitely have to be on top of everything here. Some of the other smaller counties where their auditors assist with those entries, you're still going to need to gather that information for the auditors to make the entries. But as far as your day-to-day accounting, that's probably not going to change too much. And I do have a slide with that as well that I'll go over in the past, but just to kind of to tee this up. As I mentioned before, on the lessee side, you're going to have that intangible right to use asset on the books as an asset, with the liability being the present value of those future payments. On the lessor side, you're going to have a receivable for the present value of the amounts that you're expecting to get. And then on the opposite side of that, you're going to have a deferred inflow of resources for those payments that are going to be applied as revenue in future periods. I did kind of show here what the short-term lease, like I said before, no impact to the statement in that position. You're going to continue to record those as lease expense. This would be those leases that are less than 12 months. You don't have to worry about those. Those are just kind of operating expenses. But if you do have a financing lease more than 12 months, you're going to show once again, the intangible right to use asset, and then a lease liability. And then on the statement of activities, your government-wide statement of activities, you're going to record an amortization expense against that right to use asset. So for example, you got a lease term of 10 years, you're going to amortize that straight line over 10 years to get to that final zero book value related to that asset, meaning it's not worth anything to you anymore. And then as you make those payments, you're going to allocate it to principal and interest. So on the statement of activities, you're going to have the interest portion running through as an expense. And I did show here on what you would do in your governmental funds, which are your modified accrual fund statements. So in that initial year, no impact to the balance sheet. Now, luckily, there's no impact to the balance sheet for any of this. It's only on a government-wide statement. But in that first year, in your statement of revenues, expenditures, and changes in fund balance, you're going to have to record the present value of the lease term. So that's where your difficulty is going to be, is figuring out the present value of the lease term. So you're going to have to figure out the life, figure out all the payments that you're expecting to make over the life, and then record the present value of that as other financing sources. So similar to what you would have done in the old capital lease, showing the present value of all of those amounts as other financing sources. And then the debit to that will be the expenditure that you're going to be funding. So like I said, probably the common thing that the counties would see would be police vehicles. In the past, maybe if you only rented them for 3 years of the 5-10 year life, it maybe wasn't recorded as a capital lease. It was recorded as just an operating expense. So now you're going to have to record the present value of that lease, and then related expenditure will be a capital outlay purchase for those vehicles. So you're going to have to budget and record appropriately for those debt proceeds along with the expenses. So I know in the past, a lot of times that capital outlay the recording of the capital outlay has caused you to go over budget on various line items. So you're definitely going to need to anticipate that when you're with this new GASB 87, is record those lease obligations that you tend to enter during the year, because that's going to affect your expenses and expenses in relation to budget. So that's one thing I would recommend the counties, is anticipate anything that you're going to be doing with this in the upcoming year, and record that appropriately in your budget. And then in subsequent years, in the past, you have recorded as an operating a lease expense, operating lease expense, rent expense. So now it's still going to be the same amount, but instead of rent expense, it's going to be allocated between principal and interest expense, similar to what you do now with your debt payments or your capital lease payments with principal and interest. So this is probably the most important thing for you as a county in your day-to-day operations, is knowing the impact it is going to have to your general fund or any other fund that has a lease transaction. So the next few slides are going to go into the calculation of those amounts. Like I said before, you're going to have to anticipate what those amounts are going to be so you can budget accordingly. So it's pretty logical as far as how you come up with that lease liability. It's going to be basically the present value of any payments that you're required to make during the year or you're expected to make during the year. So there's a lot of examples here. Yeah, if you're going to have any payments, like to get ready for or to get the asset ready, like so for a sheriff vehicle, if you're going to put in some extra equipment to get it ready, those are required to record it as the lease liability. And let's see, one thing it does mention is lease liability does not include payments based on the performance or usage. Probably the best example for this would be like a copier lease. I'm going to get in further whether that's going to be material or not, you have to worry about, but lots of times with a copier lease, you have it split between your payments to actually own or to use the, or I guess to have the copier on your premises, and then also a service portion, and then also maybe a portion based on how many copies that you make during the year. So they're saying that the second two of those aren't included in the lease liability. So any of those payments based on how much you use the assets or even the maintenance contracts are not included in that lease liability. A difficult thing that you need to incorporate is the discount rate. Lots of times lease agreements don't specifically say what your or what the discount rate is or what the interest rate is. So with that, like GASB said, just use your incremental borrowing rate, which can maybe be your most recent bond that you were able to obtain, what the bond rate was for that. Obviously, it's pretty low right now with interest rates the way they are. But yeah, and I guess that could be subject to judgment, and I guess us as auditors are going to evaluate whether the interest rate you're using is reasonable. So definitely reach out to your auditor, or even your lessor company and ask them what rate would you use if we were going to enter into a long-term borrowing agreement. And as before, those payments are going to be allocated between interest expense and reduction of lease liability. So a lot of definitions here, a lot of information, but maybe I'm hopefully getting you thinking about how you would handle it in your specific situation. So probably in counties, the most common ones will be that the sheriff vehicles, or even buildings. Maybe you're leasing a building to somebody else, or
Brian, you're muted right now. We can't hear what you're saying. It looks like there may be a pop-up on the. Brian, if you can hear this, you are still on mute. Brian, I'm not sure if you can hear this, but we cannot hear you at this time.
no, you can't hear me?
There you are. You're back.
Okay.
Thank you.
Okay, sorry, my headset must have went on. Okay, hopefully that wasn't too long. Okay.
I think, Brian, if you could possibly do the slide over, you were muted
Okay.
for most of it. Thank you.
Okay. So this is, I'll go back here. So this is the lease, on the lease asset side. Obviously, you're going to have an asset side and the liability side. So with the lease asset side, it's going to be fairly similar to the lease liability, but you're also going to add some other costs that you might have paid before you entered into the lease. Lease incentives do reduce the cost of that lease asset. And does say just GASB came out with another standard, debt issuance costs are going to be expensed because they have no further benefit. So anything like that still will be expensed. And then as far as how you amortize the lease asset over the life of the term, you just use a systematic and rational basis, which typically is straight line for the most part, just to keep it easy on us. And it's just going to be the shorter that lease term or the useful life of the underlying asset, depending on which is shorter. I wouldn't think you would have a lease term that's longer than the useful life of the asset. That doesn't really make too much sense. So I would say for the most part, it's going to be the lease term as far as how you're going to amortize that. And it did say here, if the purchase option that is reasonably certain of being exercised, the leased asset should be amortized over the useful life of that asset. And obviously land, you don't amortize that. Did have a note here as we kind of get into the standard and make adjustments through the course of the time. It Sometimes if you change your assumptions and you remeasure it, obviously you're not going to put that asset to be less than 0. And as I mentioned before, I could probably contracts with multiple components. Like I said, probably the best example there is the copier lease with that a portion that's the lease and the portion's the non-lease, for example, like a service component, or even like maybe I doubt you would have this and with a sheriff vehicle having a component to be a maintenance portion of that. But if you do have that, you wouldn't include that portion in your lease calculation. Another thing that they said was if you have multiple underlying assets with differing lease terms, you include those all in the same lease. So the allocation process, maybe they don't specifically state in the lease what is maintenance and what is the portion. So once again, you have to use your professional judgment to figure that out. Yeah. And then with multiple underlying assets, so if you do have assets that kind of are all similar, you can treat them as one single lease unit for your calculations. If you have multiple contracts entered into at the same time, negotiated as a single package with a single objective, you would treat those the same. As I mentioned before, unfortunately, GASB is kind of getting to the point where they're given some theoretical guidance instead of you have to do this, you have to do that. So that's good and bad. The bad part of that is if what you anticipate doesn't happen, then you have to remeasure the lease liability. So they did mention if those things change, you have to remeasure and do some journal entries accordingly. Obviously, I don't have a lot of practical experience with that because nobody's really done this yet. So it's going to be a case-by-case situation. You're going to have to think it through and look at the guidance, but that liability is going to be remeasured if you change the lease term. For example, if you initially expected to exercise an option to extend and you didn't do that, obviously you're going to reduce the lease term and adjust accordingly. Change in payments being required, the rate the lessor charges a lease if used as a discount rate. If that discount rate substantially changes, you're going to have to remeasure the lease liability. And then variable lease payments, if they are moved from one way to the other, obviously you're going to have to adjust accordingly. And it does say you only have to adjust the discount rate if the other conditions happen. So just because your discount rate changes, you don't mean to have to change it every year. So, but as you're going through the process, if the lease term changes, go ahead and update that discount rate just to kind of get that in line with what your current discount rate is. And as I mentioned before, if the lease asset goes below 0, you recognize the remainder in the income statement. Some more exciting stuff here that's going to add to our disclosures and our footnotes is what's required to be disclosed. And there's going to be a lot of things here. The one takeaway that I have of this is we thought we could just combine this with our capital assets and just add them there, but GASB said these are kind of different, so they don't want everything aggregated together. So we're going to be adding another footnote for these types of transactions. So you're going to have a similar table that you do now for your capital assets with maybe equipment under lease, vehicles under lease, buildings under lease. And then you're going to also have a similar disclosure that you do now for debt. So once again, you can't just combine it with your existing debt footnote. You're going to have a separate footnote as far as what your future payments are for the next 5 years and 5-year increments thereafter. So similar information to what you have now with capital assets and debt, but it's going to be in a different section. And then as always, you're going to have a general description of those leasing arrangements in the footnotes so people can understand what's going on. So obviously there's a lessor and the lessee. On the lessor side, it's pretty similar to what it would be on the lessee side, but once again, just kind of go through the transaction and what you initially expect to receive from the lessee, any variable payments that are essentially fixed, If you're going to get some guarantees at the end that are fixed, what amounts you expect to get, that comes in to how you calculate the lease receivable. Discount the lease receivable using the lessor's incremental borrowing rate. So this could be difficult on the lessor side. You don't know what the lessee's rate is. So it could be whatever you would give them, or you might have to ask them what their incremental borrowing rate is. So as I get in before, the practical aspects of this is going to be, that's going to be one of the difficult things that you have to account for. So fixed payments. Yeah, if you didn't anticipate some of those payments to occur at the beginning, you would recognize those when exercised. And as I mentioned before, the lessor is going to have to remeasure at some point during the course of the term if some things change. So the change in the lease term, change in the interest rate, or contingent payment is now measurable. Yeah, and when remeasuring, the index or rate on the variable payment should be updated. And as I mentioned before, on the lessor side, you're going to have a deferred inflow of resources for those payments that you're expecting for the future that will be recognized as revenue as that asset is being used. So it's going to be similar before, just kind of go through the contract and determine what payments are expected to be received. And that last bullet point. So it's going to be recording two assets because you're still going to have that underlying asset on your books and depreciated as according. So you're going to basically have two assets and then a deferred inflow of resources on your books to make it work. Similar on the lessor side, you're going to have disclosures as far as what's going on. Yeah, some reconciliations of the total inflows recognized. And then if lease payments are securing your debt, obviously the existence of those terms and what those are. Some of the things, like I said, hasn't really been implemented too much yet. People were allowed to early implement, but I haven't heard too many examples of people implementing yet. But just the initial conversations we've had with clients as far as the difficulties that they've identified or they anticipate to identify is the identification of lease can be challenging because they're spread throughout the organization, and especially U.S. counties. You have your central management, central finance department, but sometimes the communication isn't always the best from the various departments up to the finance. So kind of identifying the lease is going to be challenging. So definitely get on this as soon as possible. The incremental borrowing rate, pretty low right now, so probably not going to have a huge impact on the numbers. And so auditors probably won't focus too much on that at this point, but if rates do go up in the future, the change in that rate could be a material misstatement. So that may be an auditor focus in the future. And then accounting for these transactions. So some counties might not be impacted at all. Some might be impacted on a smaller scale, and some might be impacted on a larger scale. So I've had some counties that set up this Excel spreadsheet to account for the transactions, and that'll work for their system. But there's also accounting systems that are going to be implemented and available to help you implement. I know us at Wipfli, we partnered with a firm that is doing this, so we do have that available, and I'm sure there's going to be more out there available as far as getting a system to account for these transactions and make it easier for everybody. And then you're also going to evaluate or create new internal controls for this system to make sure that all the accounting for it is done properly and you get all the approvals for these amounts to be done appropriately. And then everybody in the organization is going to really need to know what these standards are, because as I said before, they could affect your budget as far as going over a budget if you do enter into a lease in the current year. And obviously that's never good at the end of the fiscal year, 6 months after the fiscal year when you're getting your audit done, to tell departments, oh, you went over your budget. So definitely more proactive discussion to get everybody on board with the same same things. And then as they're negotiating the lease terms, to know what the impact is of various clauses or various things that they're agreeing to. So just getting that education through everybody. As I mentioned before, GASB did give us a little reprieve as far as when this needs to be implemented. So for you as a county year end with 12/31, it'll be for the year ended December 31st, 2022. You can implement early if you would like, and it's encouraged. This is one of those standards that's going to be applied retroactively, which means that you're going to have to restate your financial statements. And if you do a comparative statement, those prior periods will have to be presented. I typically don't see that too much at a county level, but you could have prior periods. So if that's the case, we're currently in the year that you're going to have to restate. So the more you can do now to get ready for that, the better. And I guess I should say with your fund statements, as I mentioned before, you probably won't have to restate too much because there is no balance sheet impact in accordance with modified accrual. Really, the only impact going forward will be allocating the rent expense to now principal and interest. So I guess that's good as far as how your budgeting goes for prior period misstatements. The only impact to you will be if you enter into a lease agreement during the year. So probably typically you won't have too many restatements, but you will have to account for this if you do enter into a new lease during the year. And as I mentioned before, they're recognized and measured using the facts and circumstances that existed at the beginning of the period implementation, but facts and conditions change. So you're definitely going to have a system in place to know when those conditions changed and when you have to evaluate. I know us as auditors are probably going to sample leases various times during the course of that lease to kind of ask some questions. Does this change? Do you expect to do that? So you don't want us auditors come in and say, oh, you got to make this change after the fact. So the more you can do upfront to have a system in place to make sure that you account for those changes, that's good. So what can you do now? Research all your bills coded to rental expenses. I'm sorry, lease expenses or similar codes in your accounting system. And then also review your check register for any recurring payments, because obviously that's an indication that you might have an agreement in place to pay a certain amount over the course of time. So probably any building rent payments that you're making or receiving. Probably, I'm sure all of you have a good handle on your sheriff vehicles, or the sheriff should. So get an idea of your vehicle schedule there. Copier leases may or may not be material. And what are some, I think that's probably the main things I can think of. I'm sure I'm missing something. And if somebody wants to pipe in for an example they want me to talk about, we can talk about that at the end. But with those payments, you're going to have to locate the agreements as far as what you're required to pay and match those up and get those all in one central location for certain person or a certain group of people to analyze and determine what the accounting is going to be for that and what required reporting you're going to have and what transactions you're going to have to do. So the more you can do with that up front, the better, just to kind of see how big of an impact this is going to be. Hopefully it won't be too much of an impact, but I do feel like it could be a substantial undertaking for certain counties. As I mentioned before, and the good thing with accounting is we can consider materiality in everything we do. It's just sometimes it's not worth the effort it takes to get that information ready. So one of the questions as we do these presentations is, can you use the capitalization threshold to kind of evaluate these leases? And the answer we got from GASB was no, is because there's a different transaction threshold for capital leases to lease liability. Sometimes you might, let's see, if you have like 200 copier leases or 200 copiers under the guise of one lease, obviously each one of those individually immaterial, but when you look at it in total, if you don't include that, could be a big liability that you're missing. Kind of the same thing with maybe a vehicle. Typically vehicles are probably over most people's capitalization threshold, but maybe at a a bigger county, that wouldn't be, but if you have, like I said, 30 or 40 sheriff vehicles, obviously not including those amounts on the balance sheet would definitely be misleading. So I'd say that the materiality here is more in total, making sure that if you're omitting certain capital leases, it's not going to be immaterial. So with this, I would definitely get in touch with your auditor to get their ideas on materiality. And with that example before with copier leases, maybe if you're only paying 2,000 or 3,000 a month and you're a big county, probably not misleading to not include that. So you can consider the materiality and maybe getting out of how you account for these. So with that, definitely policy is always good to have up front to make sure that everybody in the organization knows what your threshold is for assessing leases. Operationalize that reasonably certain. What does it mean? I mean, just because somebody at the organization says it's going to be exercised, you definitely want to have everybody that is allowed to make a decision related to that involved in that decision. Operationalize the allocation procedures for those non-lease components. For example, whether it's a service part of it, a lease part of it, how you kind of determine that. And the more you can kind of put a policy in place and not have to go lease by lease and make a lot of judgment calls, the better. And obviously develop that system to capture the data and do the accounting or get the accounting ready for those transactions. And then implement an accounting review for those future lease commitments. So kind of get somebody in place to kind of analyze those new contracts and maybe even establish a procedure for somebody be contacted before you even enter into those new contracts to make sure that you account for everything possible and make sure there's nothing in the lease agreement that's going to cause you to have unfavorable bond covenants or bond ratios. Probably not too significant at accounting level, but it's possible that there might be something in there that you can do to kind of get the numbers more in your favor. And then obviously, as I mentioned before, any new assumptions are going to have to be accounted for with changes. So getting steps in there to make sure you address those changes. And then, review leases at least annually or even more often for potential changes in measurement. So just probably having somebody at the organization that's what their responsibility is, to kind of go through these lease agreements and update those and make sure they're accounted for properly. So with that, looks like I got about 15 minutes left. Is there any other questions that anybody has that they want me to go over? I know I threw a lot at everybody, and it can be overwhelming as you're doing these presentations, but hopefully as you slow down and just anticipate what your agreements are, kind of just slow down and work with people. I mean, I'm getting questions from our clients all the time, and for the most part, I slow them down and say, this is pretty simple when you just think of it from a higher level. So hopefully it won't be too bad. And once we get going here and get a system in place, it shouldn't be too bad going forward.
And as a reminder to all attendees, you can put questions in the chat or the Q&A. We will post a recording of this webinar on the WCA website along. Brian, if it's okay with you, if we could post this presentation as well as a PDF that people can use as a resource.
Yep.
And with that said, if we don't have any questions at this time, Brian, I don't know if you have any final comments. And if not, we thank you tremendously for your time and for Wipfli's time and support of the Wisconsin Counties Association. We are grateful for that.
Yeah, I mean, like I said, I do have a lot of information in these slides that hopefully helpful. I mean, GASB 87 in its total is probably like 100 pages or so. So you could go back to the specific guidance. There's an implementation guide to review. So there's a lot of information out there. It can be overwhelming, but like I said, if you apply it to your specific situation, it shouldn't be too bad. I mean, I always say with new accounting standards, it's always overwhelming at first to kind of get your arms around everything. But as you get through that first year, it's not too bad. Maybe second year, you think, oh, shoot, I didn't anticipate this. And we get it accounted for correctly. And then as you go forward, it's not too bad. Obviously with this one, it's going to be in play for a lot of years as we go forward, as you enter into new lease agreements and getting it right. But hopefully as we go through and get a system in place, it'll be similar to any other standard. GASB 68 with pension, GASB 75 with OPEB. That was definitely painful at first, but hopefully we learned from that, and that's a lot easier as we go forward. So hopefully this just becomes another standard that you know how to address, and we can put that in our back burner as far as how we account for it. So
Great. Thank you again, Brian. And for all attendees, as I mentioned, we will post this, and we will also be sure to post Brian's contact information for additional questions. And with that, I think we're ready to wrap this up. Again, thank you so much for your time, everybody, sharing it with us. And we will talk soon. Thank you.
yeah, thanks everyone.